Hey everybody, this is Alf speaking. Welcome back on the Blockworks Macro YouTube channel. Today's guest of the show is Mr. Blonde Macro, who's a seasoned professional in the industry, who now is writing one of the most interesting and successful macro equity-based newsletters out there called Stuck in the Middle. You should absolutely check out if you haven't already. Hey, Mr. Blonde, how are you doing?
I'm good, Alf. How are you doing? Thanks for having me.
Hey, it's my pleasure to host you on the show. Actually, I want to talk about the view that you had on the equity market back at the end of September when you talked about the distinct possibility of an equity market rally, which actually materialized all the way until today. But, you know, the past is the past. Very good call, Mr. Blonde. But I want to get your head about what's going on in the equity market today. How do you see the risks of upside and downside ahead for the next 3 to 6 months?
Yeah, thanks, Alf. Look, at the time, the call was, really predicated upon, what I said was, is that we had the preconditions for a bear market rally. The preconditions being we had pretty material oversold conditions. Sentiment, obviously got pretty bearish and people were concerned about a number of things. Some of the things that have been in place all year, but, they go into waves. And then, and we had, positioning had come off. And all the rest. And, you never really know what specifically will trigger the narrative or, what the narrative will be subsequent to a price move. And obviously this bear market rally, it started out of the gates pretty hot, in the first couple of days of October and then came off, but, kind of never really made substantial new lows. But the behavior, throughout the month of October, I think kind of highlighted that, downside, it was, we kind of felt like we had downside support from that, kind of late September level. Look, I mean, my view from early October, around the time was that, maybe we could get to 4,000 on S&P. So, at 3,900, I kind of feel like, the bulk of the move is, roughly happened. I do feel like things are a bit more balanced here, in terms of directional view. And I feel like the market now is kind of left waiting for something new, either new on the positive side or new on the negative side, to be the swing factor. So not to, kind of give you a half-assed answer, but sort of feel a little bit more neutral, about market direction here. I mean, it certainly could see the case where we still kind of get to that, kind of roughly 4,000 level, or, and the other, at the technical aspects that are associated with that level on S&P. But at the same time, I mean, I think over the course, and we'll talk about earnings season. I mean, I think over the course of the last couple of months, I mean, I think we've seen that sort of beneath the surface, fundamentals are deteriorating. So that represents, I think a pretty important drag on markets, and certainly as time passes, it sort of, I think probably limits in a pretty significant way the scope to, for that rally to continue. So a little bit more balanced, awaiting new information.
So of this new information, Mr. Blonde, I would say there are three main things to have a look at. There is an event ahead of us, which is the midterm elections in the US. There is earnings, which are obviously the earnings season is well advanced today, but let's say earnings going forward as well. And then there is a bit of seasonality at play that I want to discuss with you as well, as you come from an institutional background like I do. Maybe we can shed some light into that November, December seasonality. Let's start from midterms, if you don't mind. So do you have a particular view there, something you are specifically looking at?
No. So look, I'll say up front, I'm not a political strategist, and politics in general don't carry a big weight in my framework. Not that politics are not important. I just think that politics tend to be important over a much longer time frame than I generally, react to. Obviously that's not always true. I mean, if politicians are making tangible policy changes, then, tax, changes or whatnot, that can be important. And, generally speaking, I think presidential elections are far more important than midterm elections. Obviously, midterm elections can kind of be an indication of the direction that things are headed, and or it could be, kind of quote unquote, a vote of confidence or lack of confidence in the current administration. And I think that that's probably the main message that we're going to get from U.S. elections today. But I also think that over the last, kind of month and a half, I mean, I think the markets, kind of sees the writing on the wall. Republicans are going to take the House. And there's a really good chance that they're going to take, a bunch of seats in the Senate. And we can debate whether they get into a majority position or get close to a majority position. But I feel like that's all kind of reasonably well known and understood at this point. I mean, confirmation can be worth something, but I don't think that I don't expect any big surprises on that front. And then more important as it pertains to markets, I just don't see anything tangible coming out of this election outcome. Tangible meaning like there will be no policy agenda that's like really different than what we have today. And so I think it's a little bit of a non-event. I mean, there'll be headlines and there'll be a lot of political, people who make a lot of noise about it because this is the only thing that they focus on. But I think I don't think it's not a main market event in my opinion. I mean, I can give you, I think the negative scenario would be if Republicans ended up not doing well in the elections. I think that would be taken negatively because you sort of end up with more of the same. And then on the positive side, I think if you wanted to create a bull case, you would say this is a bit of a referendum on current the current sort of political agenda. And when I say referendum, I mean on the idea of fiscal spending and big budget deficits, so to speak, right or wrong, whether this is I know there's obviously a lot of people out there who view both parties as doing that, and there's some truth to that. But more recently, I think obviously because of fixed income and Fed tightening and inflation, these other issues, to the extent that the policy political landscape changes and it kind of cuts off the ability for fiscal spending to be part of the narrative or be part of the storyline, I think you could make the case that that's quote unquote bullish or constructive for duration in a way that you remove that tail. Yeah. And then, it kind of becomes a little bit more just about the Fed and inflation. And you don't have the risk of, some other policy decision coming along to upset things. And, the reason I think that's kind of interesting is we just saw what happened in the UK. So now you would have sort of another example of this in DM. And I think that would kind of set the stage for like, okay, we actually are kind of shifting back towards quote unquote austerity. Now, maybe that ends up not being the case 5 years from now, but at least for the next 2 years, that would seem to be, their narrative and storyline. And so it kind of simplifies markets a little bit.
Yeah, and that fiscal implication, I think, is one of the most important ones for macro in general, because effectively, if we get to a tighter fiscal stance, you'll be withdrawing resources from the private sector. You'll be taking a basically further hit on growth and earnings going ahead on a marginal perspective, but also at the same time, you would lend a hand to bonds and duration because the issuance will be coming down and the effort that the private sector will need to do to absorb net issuance will be lower. So there will be different forces at play if that fiscal stance becomes tighter. But again, it depends from the distribution of seats. In general, I feel from what you say that you don't have a major view, neither you think that the impact will be massive from midterms. So that makes me move to the second point, which is I would like to go a little bit into your very deep analysis of the earnings season. I know you do a very good work on looking at sectors and the trending stuff. So tell us what's the big picture message from the earnings season so far?
Yeah, look, I mean, I think the big picture message is actually somewhat similar to what happened in the second quarter. So now we have kind of 2 quarters in a row of this, which is expectations and numbers for the quarter came down meaningfully in the 4 to 6 weeks prior to the quarter. In aggregate, companies beat these lowered numbers, but they beat by a much smaller amount than they typically do. And then on the back end of reporting, the numbers for the subsequent quarter are coming down. And, in corporate guidance, and, sort of analyst read of momentum is that, the next quarter, won't be as good as they thought it, will be. And obviously as well as the out year. So I would call this a smaller, low quality beat and cut. Right. And, it's just, I think it just highlights that we're very clearly in the negative, negative revision cycle, negative, kind of momentum cycle for earnings. I mean, we're still marginally growing versus a year ago, but it's a much narrower margin. And when you exclude some sectors like energy, we kind of, it goes into negative territory. But more importantly, in my opinion, more importantly, the numbers for the subsequent quarter and for the subsequent year are coming down in a pretty material way. All of which is necessary, but it also, it's reestablishing your, kind of fundamental foundation when you think about, what determines market, fair value. For some context, if you look at 2022 EPS, so for the current year, I think one of the things that kind of struck me recently is that, only a couple months ago, and this is already included, half the year already being accounted for. We had, 2022 EPS for the year was set to be around $222. Mm-hmm. Well, after sort of third quarter reporting season, it now is more like $217.5 or like $218. That is a pretty material change, kind of late in the year. And obviously, so that's such 2022. Now, on top of it, 2023 numbers have also come down in a pretty material way from, earlier this year and are now at, let's call it like $230. But it's, we talked about it before. This leaves equity markets feeling like a negative carry asset. Your, EPS number keeps coming down. And, unless you can make the case for material multiple expansion, which I think is incredibly difficult to do in a time when the Fed is still actively tightening, then, you're facing pretty stiff headwind, for price appreciation.
Yeah, which makes me think of the stages of bear markets. So in 2022, we had a bear market lag that was mostly driven, let's say 80-90% explained by large multiple compressions. Now we're getting slowly into a phase where we move from that part of the bear market explanation to basically earnings being revised down. And that reminds me a little bit of 2001. Mr. Blonde, when earnings started dropping pretty materially. And in 2000, you got the leg of the bear market, which wiped out the excess risk-taking and companies trading at 50 times sales of the dot-com bubble. But then in 2001, we saw earnings dropping. So I don't know whether you see similar parallels with that period. And if you do, in general, the question is, how does a second leg of a bear market that is based rather on earnings downgrade than on multiple compression look like?
Yeah, it's a good question. I haven't studied 2001 in detail, but what you're describing makes a lot of sense because the initial part, the initial part of 2000 was really just about valuation compression, Fed hiking, and obviously it took place over a longer period in that cycle. it could take place over a similar time frame this cycle, although I do feel that this cycle is happening much faster and in a more compressed period of time, meaning sort of the COVID recovery, stimulus, was much faster and more robust. And obviously I think, some of the things that we've experienced over the last, it's only been sort of 11 months have been, compressed as well. I think to answer your question explicitly is that earnings driven bear markets are just a little bit slower. Mm-hmm. So they don't operate with the same speed. I think they end up, kind of being a little bit more episodic, like we've seen recently, which is, during a period where numbers are coming down, stock prices are coming down with it. That negativity is picking up, and then at some point, you sort of hit pause on that, or like that part of the story or the narrative, kind of is less important, and it gives the markets sort of an opportunity to kind of catch its breath a little bit, results in a little bit of a bear market rally. We focus on something else or some other storyline or some other narrative where we say like, oh, well, the Fed's going to pivot, or whatever the flavor of the day is. And then, the market gets, kind of rallies a little bit, but you'll find that it has a hard time making, higher highs. You're right. Or you find out that you're running into sort of valuation issues sooner because obviously your EPS or your fundamentals continue to deteriorate. So I think of earnings bear markets as sort of, being a little bit more about the trend. And then obviously you're trying to overlay, kind of sentiment and some of these other kind of, much shorter term, kind of trading signals, to oscillate around that trend. But the trend, ends up being, kind of a little bit of a strong, persistent force, in the market.
So if we are looking at something that is slower trending down as your base case, but with wild swings around it, which can be periodic drops idiosyncratically related to a certain earnings miss perhaps or around earnings season, but then vicious bear market rallies that are driven by a change of focus, which is temporarily on something else. My question is, if you look into 2023, which is probably the question most investors are asking themselves, we should think in probabilistic terms, right? So it's not a one-off question, black or white, but what's your base case for earnings per share and valuations in the S&P, which ultimately lead to your base case target? Let's say 6 months ahead. 12 is way too long as time frame in macro, but at least for the next 6 months.
Right. So I have an earnings model that I've used, and something presented at the start of this year, which basically said that this year we would have growth deceleration, probably would end the year being sort of small positive, but down substantially in a second derivative context.
Yeah.
Next year is a negative growth year. And the model, indicates something, on the magnitude of, earnings being down 15 to 17% from year ago levels, as of the third quarter of next year. I don't see anything in the last couple quarters of reporting season to suggest that forecast is not on track. If anything, I think the forecast, it would suggest that we're actually slightly ahead of that forecast, meaning like some of the deterioration is happening sooner. So maybe that means that the negative growth in 2023 isn't quite as deep as it would have been otherwise when you think about the model, details, because some of it happened in 2022. But on the whole, it looks like we're on track for an EPS figure that could be as low as sort of 185 in 2023 at some point versus, like I said, the current 2018 trailing, 12-month EPS number. Now, to put that in context, and I did some work on this, around like looking at EPS drawdowns around recessions, that's a roughly 15% drawdown from, peak EPS. So that's not really that it's very much in line with what would happen in a quote unquote normal recession. It doesn't have to be like a severe 2008 style recession to kind of create that kind of drawdown. So that sort of checks one box. Like I said, the earnings model that I have is already forecasting that, and it's not a model that explicitly forecasts recessions. It's focus on the profit cycle. Obviously, they tend to be related. So that seems like a reasonable, let's call that the mild bear case. But I have been using a number that's more like $200 in 2023, somewhat conservative. But I think even at $200, you're trading at 19 times PE multiple in an environment of negative EPS revisions and a Fed that's like unsure whether they're going to hike 50 or 75 next meeting, right? So it just seems like a pretty rich multiple to pay for a market where we're still in the midst of decelerating growth, Fed hiking rates, and the recession question is still very much in front of us.
Yeah, and that's a very, very similar approach to my macro models, Mr. Blonde, where my base case 2023 EPS will be $195 to $200. So we're roughly on the same page, looking at indicators which are sometimes similar, sometimes a bit different, but we come to the similar conclusion. So effectively, you're looking at a negative carry when it comes to earnings per share against analyst expectations. So you're sitting on something that on a fundamental cash flow basis will deteriorate. So unless multiples expand very fast compared to what the forwards are implying today, you are looking on something that will probably lose you money from a long position. Now, when it comes to multiples, I had a little bit of a look at the first quarter, second quarter of 2001, when the Fed did pivot. They cut 150 basis points in 3 months between December 2000 and March 2001 because the labor market was weakening and because earnings were dropping very fast and because they thought they had done enough damage, basically. And inflation was also slowly but surely on a momentum basis coming down. The Fed, cut 150 basis points back then, but equities dropped another 12% in the first 3 months of the year. So that multiple expansion solely coming from bonds rallying, if you want to put it like that, mechanically speaking, is not that automatic in an environment where risk sentiment is low and earnings are deteriorating, right? It's not that simple as to say that the Fed pivot will be bullish for valuations.
No, I totally agree. Listen, I think quote unquote pivot is, when I think about pivot, I think of a change in direction. right? So a pivot is not going from 75 basis points to 50 basis point hikes. Well, we should call that something different. I know that there's, obviously people have a lot of different ways of expressing, that narrative. And I think we're in an environment, and as is typical in a Fed rate hike cycle, is they usually, they don't stop until they run into something. And so, and unfortunately, when they run into something, I mean, we hope that it's a small something and not a big something. But when you run into something, that usually, causes some damage. And so I think that that's kind of what you're referring to. And I would say that that's, very consistent with my own view and perspective. And I think it could be earnings related, that spills over into the real economy. And that obviously if companies are making less money, or in some cases losing money versus a year ago or 2 years ago, they're going to retrench. They're going to spend less. They're going to hire less. So it's, profits are the lifeblood of economic activity. And if there's less of them, or they're in decline, then it's a form of retrenchment, and that will spill over to the real economy for sure.
That's true. And now we're talking about let's say an earnings driven lag of a bear market that we expect to, as a base case, expand into 2023. But this is rather a medium-term macro projection, let's say, or a base case we're depicting for maybe 6 months ahead. Right. But what about between now and Christmas? Because as you already described, Mr. Blond, there are more technical driven bear market rallies that we might face in the meantime while we look at this long-term trend. So can you talk to us a little bit about whether this rally could extend to 4,000 maybe by Christmas, and why actually we're having this technical rally in the first place?
Yeah, no, I mean, I think we could. I mean, from here at 38.40, 4,000, not that far away. It's, a few percent. So I certainly think that that's possible. I guess, one of the metrics that I like to use when I think about, S&P price levels is, I try to rely a little bit more on the PE multiple, which I view as being the real price of the index. That's the valuation profile determines, kind of how far you can go. And one of the things that I found useful to use over time is the 2-year trailing or the 2-year rolling average of PE multiple. And when you look at it in periods when the Fed is hiking, it's generally pretty hard for the valuation multiple to get to be above its 2-year average, right? Because you still have liquidity being pulled from the system. Obviously, you're trying to constantly evaluate the impact from that financial conditions tightening. It tells you that future growth will be lower. And so that represents a bit of a ceiling. So today, 17.5 times, or roughly 17.5 times, will get you to that 2-year average. And then you play the game of 17.5 times on the 230 number is 40.25. So I mean, to me, like, that seems like that's an area at that level. I'm probably going to be thinking a little bit more about the short case than chasing it from there. Look, I think we could have it in or around midterms. I mean, obviously people are thinking about change in political environment, certainly as was one of those reasons that we can oscillate around the trend. And now that we're kind of largely past earnings season, you sort of lose some of those negative headlines, and you're a little bit in this kind of shoulder period as we wait for the next event. And obviously holiday rich time of year, so people are off. One last point, if I could, which I think is also probably related, and you mentioned, kind of institutional behavior and psychology. I mean, one of the things that I tend to think about in this time of year is the willingness to take risk, or risk tolerance, is decelerating at an accelerating rate. The large majority of institutional participants are paid based on their calendar year P&L.
Correct. And
so at this time of year, the willingness to make a big bet or go against the trend in November, is significantly smaller, because nobody wants to have that big mistake and not have enough time to fix it or make up for it. So I kind of think that, this is, probably one of the reasons, like, the market kind of will have a tendency to kind of go with whatever the prevailing trend is. Or maybe we want to think about this being a season where we're going to end up with a lot more gamma, and that, if the market's going up, then it maybe goes up a little bit more velocity because, everybody is going to, kind of cover the shorts that they have in place and try to, go with the flow. On the flip side would be true as well. So but there's also the tendency to, have more profit taking, and, to, book P&L at the tail end of the year as people are looking to, kind of lock in and move on. And then come January 1st in the new trading year, things can move, in a more dramatic fashion.
Absolutely. I share this 100%. Used to be short on the Russell 2000, my index of choice for the short, until 2 to 3 weeks ago. Took profits on that, and since then actually not very interested in chasing the rally, but actually it could extend pretty easily to 4,000, which is a target I'm also looking at to potentially re-enter more medium-term oriented short positions. I mean, if you think of an institutional investor, Mr. Blonde, right now, you either were taken away for a ride in 2022 and stopped out of your longs multiple times, or you were short the whole time and had a brilliant year. In any case, right now, you're looking pretty light from an institutional perspective positioning, or you want to hedge your upside risks. You don't want to, fuck up your bonus payment at the end of the year because there is a Santa Claus rally, which is a 15-20% rally, and you are not participating into it, or you're getting flushed out. And that is also reflected in the fact that the institutional investors seem to be willing for upside, paying to upside calls much more than they're willing to pay for downside protection, which also seems to suggest that if there is something to hedge right now, it's actually a very large bear market rally that could, rattle the bonus payment of some of the hedge fund managers out there. This also obviously leads to a bit of convexity and gamma on the way up, as you said. It could happen, but actually, if you ask me, rather than try to chase that, I would rather use that as a good setup to think of a medium-term macro short back again in 2023.
Yeah, I kind of think the same way. I mean, like, listen, if I had to, paint the picture of like what would represent, a bit of a pain trade for people would be, after a pretty difficult year and performance amongst sort of a large portion of the institutional community has underperformed or has performed poorly. If you got a late year rally, it probably would be pretty frustrating to a lot of people. And sort of make their full year performance look worse, right? Than maybe otherwise, than the reality might be, otherwise. So I could certainly see that being the case. I guess it's, again, like, put that in the bucket of a trading call or sort of sentiment, driven, kind of market technicals rather than something that's indicative of fundamentals or some material change in the fundamental backdrop. And it's always, hard to clearly differentiate the two when communicating your view. But I think that's it's certainly a possibility. I think call spreads, are probably one way to do that. I mean, you mentioned, kind of the vol on the upside is, a bit higher than normal. So certainly would probably want to, if I was playing for that, I would want to do it in a spread format and, limit that a little bit. But I'm not seeing a case to play for it aggressively from current levels, like it did in late September.
Yeah.
I mean, I think that's probably the other thing. It's like some of what happened in October, I think, was contemplating some of what we're talking about now. So it's always hard to know, how much of that has already been, kind of digested and considered. Maybe we'll have a better, idea later this week. I mean, look, obviously we didn't talk about it, but there's a big CPI report later this week too. I think that's one of the other things that probably looms large and limits, how far markets can go after midterm elections. You certainly can make the case where there's a downtick there, and then that feeds the idea of, rates can come, can relax or come off, or rate vol can come off, which is, recently has been an important contributor to equity markets relaxing. The flip side is if that's another number that looks stubborn or hot, then you kind of go quickly short circuit whatever, quote unquote, good news comes out of midterm elections.
That's indeed correct. And it's always a pleasure to talk to you both about medium-term macro and equity outlook and short-term technicals, because you've been in institutional seats, buy side and sell side, for long. So you can definitely navigate both time frames with great ability. Actually, before I let you go, Mr. Blonde, if people haven't heard about you yet, or they want to find more about you, where can they do that?
Sure. Yeah, thanks. Well, so Twitter is the easiest place to find me, and at Mr. Blonde _macro. And then there's sort of more information about there on the feed. And, I've also been writing on Substack under Stuck in the Middle. And you can find, sort of some deeper thoughts and analysis and data-driven views there. And then, obviously, you're kind enough to invite me to talk every few weeks. So I'll probably be back here again soon too.
Yeah, it'd be my pleasure to host you again. Thanks for the chat, and we'll talk soon.
It's great. Thank you.